Hey everyone, welcome back to AWM Insights. I'm your host, Brandon Averill, along here with our CIO, Justin Dyer. And as you know, each week we cut through the noise of what Wall Street is selling you to bring you the knowledge, skills, and access that you need to invest like a pro. And today we're going to tackle kind of the third leg of a topic. We've talked about where you actually need to get your advice from, when's it a good time to invest. And today we're going to talk a little bit about how you actually go about building the professional portfolio. But as we always do, before we jump into that, let's recap a little bit what's going on in the markets.
So some good news coming out on the economic and earnings front. Jobless claims last week hitting a new pandemic era low. Continuing claims, I believe, also hit a new pandemic era low. So both moving in the right direction. Again, I'm sure we've mentioned this time and time again. These type of statistics bounce around a lot. It was a couple weeks of jobless claims that were moving upward. We're seeing a turn, and it was a pretty positive turn in terms of magnitude. On the flip side, inflation is still stubbornly high. We've talked about that a number of times on this podcast. Along with inflation, and largely could be argued that this is driving inflation. The supply chain headaches are still very much in place here. And then again, on the flip side here, we have earnings coming out. We're kind of hitting our stride with earnings, and it is shaping up to be another pretty strong and positive earnings season. Expectations were pretty high. So far, actual results have outperformed expectations for the most part. So that could be a continued driver of market performance. We don't have a crystal ball. Who knows? So take that with a grain of salt.
You
But
mean
that's what we're
inflation's
seeing.
not going to totally crash the markets this next week? That's
No,
what I'm
man.
hearing.
Well, let's put some money on it.
Yeah, right. No kidding. Well, if everybody else is gambling, we might as well too, right?
There you go. On the labor front, so we talked about jobless claims, but there's some stirring up, if you will, a factory workers for John Deere. They went on strike last week, trying to get higher benefits as they always do, and really participate in the growth that companies like John Deere are experiencing. So see how that works out on the flip side, from a labor perspective. This is, I think, pretty big. We've touched on this, and it still is a long story to go, but it's been a long time coming. The global corporate tax rate looks to be in an agreement amongst what are called the OECD countries. It's an organization of wealthy countries, they call it. They've agreed to a 15% floor on the corporate tax rate. Ireland was the longstanding holdout there, and there is a tentative agreement there. Now countries have to go and approve it, so there still is plenty to unfold in front of us. But it's pretty big if this actually does come to fruition, which we got another step closer to actually making that happen. LeBron, on the sports front, LeBron sold a big stake in his media group to Nike, Redbird, Fenway, and the Fenway Sports Group. I think it valued it around $750 million. So hey, kudos to LeBron. Then on the Asian front, LinkedIn shuttering its platform in China. Not the first social media platform to do so, but basically just kind of throwing up their hands at this point, saying it's too hard to do business with all the requirements and whatnot. Then lastly, on the news front, just wrapping up things up here. So probably as this is going to air, it looks like it's likely that there's a Bitcoin futures ETF that's going to start trading. That's big news. That's one of the reasons Bitcoin and a lot of other crypto have been spiking recently. I do want to underscore, though, it is not holding Bitcoin directly. This is a Bitcoin futures ETF. The price will not move in the exact same way as the underlying asset. And it's really, really important for folks to understand that. There are a lot more very efficient ways to hold cryptocurrency if you're so interested. And again, we've talked about some of those in the past, but a Bitcoin futures ETF, in my opinion, is not the best way to go if you're interested in that speculative marketplace.
Well, I think Justin, that's a perfect transition, right? How to actually invest like a pro and not fall to the marketing of Wall Street. I mean, we've seen these types of ETFs pop up, and I think unfortunately, these ETF structures have also become synonymous with index type approaches as well. And a lot of people don't understand the actual underlying instruments and what they're actually investing in. And so it would be, I think it would be fun for us today to dig in a little bit into, okay, great. Now I've determined, where am I going to get my advice? Okay. I'm not in the mass affluent. I don't have all of my savings sitting in a 401k program. So going to the big wirehouses probably isn't in my best interest. And we certainly would argue it's probably not in anyone's best interest. However, I certainly understand the need for a multifamily office or a family office structure if I have any significance of wealth going on. A good benchmark, right? If I'm at all worried about these potentially changing estate tax, legislation that could happen, we should get as far away from the Goldmans and the Merrills and the Morgans and all these wirehouses you possibly could. So we've tackled that. We've tackled, when is it actually a good time to invest? Markets seem like they're doing extremely well at times. We're towards market all-time highs, valuations seem high, et cetera. That natural feeling of, is now a good time or should I wait? We know when's the best time to invest? Now. You should always be invested, right? With the money that you should be investing. I think we went over that in a last episode. But jumping over to the how we should actually invest and building that truly professional portfolio, right? I'd love for you to hit on for us a little bit. We've talked, we certainly have beat down the active management argument. We know the evidence is strongly against that. But what we haven't talked a whole lot about is the indexing approach, right? And the potential pitfalls there. What is an ETF? Are all of these things constructed in the same way? Should we just be indexing, or is maybe there a better way? If you could maybe jump into that a bit, I'd love to hear your thoughts.
Yeah, well, it's a meaty topic, so we'll try and stay super high level here. But within a multifamily office approach, I think I want to highlight that the two most important facets of that approach are integration and independence with respect to this conversation. So independence, we're independent of Wall Street. We'd say that time and time again. We're not producing product that the big banks are producing and then having their advisors, their financial advisors, then sell that to their clients. We talked about, what was it, HS or UBS, I believe it was, offloading their Evergrande bonds to
Credit Suisse.
Credit Suisse, one of those Swiss banks, offloading their Evergrande bonds to their actual clients, knowing that they were too risky for them to hold on. Right? That is the independent nature of what we do. We are not beholden to any single entity or product out there. We can really truly build a portfolio that is in your best interest. How do we go about doing that? So Brandon, you mentioned we've talked about active. We know the pitfalls there. There are also some pitfalls with respect to passive investing. You can invest passively following an index. S&P 500 is being, probably the more common one. You can even buy products or mutual funds or ETFs that track the NASDAQ. I mean, the list is amazing nowadays, but there's pitfalls with going that route. An index is a very very tight rules-based construction, or rules-based basket, if you will. And what has to happen, the investors and those that are trying to track an index, is these index providers need to very clearly state what is going on with their index. A perfect, relevant, recent example is the S&P 500 adding Tesla to that particular basket of stocks. And what happens is, it's called reconstitution. Somebody has to fall out of that index and another company has to go into that index. I mean, they are literally telegraphing to the market what has to happen. And if you are an index tracker, you have to buy Tesla on the day that it enters the index. So, I mean, and that's just a silly activity to participate in, right? And what you see is people are smart enough to buy Tesla ahead of that date and take advantage of that spike in price because they know they're going to have willing buyers on that date. And it's just silly. So you basically take the best way to kind of, let's say, blend the world of active and the world of passive is to take the rules-based approach, the systematic approach that index providers provide, sorry to be redundant there, but be smarter than them. And don't participate in these silly reconstitution days when a company gets added to or subtracted from a particular benchmark or index, and trade smartly. So there are studies that show you are giving up performance relative to the index just by blindly participating in that actual event. There are other things you can do about trading smartly, and patiently within the marketplace, not just when there's a liquidity event or need for liquidity. You can take advantage of things that are called momentum and whatnot. And I'm really trying not to go too much down a rabbit hole here, but there are ways in which you can focus on parts of the market that are have historically outperformed relative to the benchmark. We say small and value companies throughout this podcast. Those have tended to outperform the benchmark as a whole. So let's favor those relative to what the benchmark does. So, and then we talked about the actual vehicle, mutual funds versus ETFs. And the short answer is they can all be good for a given situation. Add in their separately managed account in certain situations. We aren't beholden to a specific product or a specific vehicle type. We will do what is truly in the client's best interest and do it in a customized way. So what dictates how the actual portfolio looks at the end of the day is your unique financial plan, using your priorities to tell us how much do we want to have in very high quality, stable assets? How much can we actually put at risk in the market? How much do we then want to put at risk in the public markets versus how much do we want to put at risk in the private markets? The private markets is a completely different ball game to an extent. Being active there, having specific access, focusing on outperformance even more so than we do on the public market side makes all the sense in the world if you have the asset base, which within a multifamily office structure, most of our clients do. And I just want to add, and I'll stop because I'm going on a rant here, but within that private market space as well, you need to be very cautious today. You mentioned that valuations are maybe high on the public market side of things. There is so much money chasing after private assets today because people are looking for alternatives. The interest rates are low. Equity market returns have been very good. What else is out there? And so prices are being bid up into the private market space because returns have been quite good there. And people are just throwing good money after bad, just because it has the label private slapped on it, doesn't mean you're guaranteed to have outperformance. I mean, access is critical. Patience is critical on the private side of things. So, that I think in a nutshell is how we go about thinking about investing, really from a, say, 30,000 foot standpoint. It's customized, it's integrated, it's independent, and it's very thoughtful around how we're deploying capital. But we are deploying capital because it makes sense to invest in markets how they are. You can't control the market you're investing in today, and you don't want to miss out on those long-term returns.
No, I think that was a really great summary. And I'll hook on to the private example here. I was just spending the weekend with some venture capitalists, and it's fascinating when you sit around with these folks and you hear about their process and the deal flow and how many opportunities they look at, and what they get right and what they get wrong, and what those what the odds are. And then you start to contrast that with maybe a client that sees a couple deals or somebody sends them something, and you just quickly realize that unless you're immersed in this, unless you really are getting that deal flow, I mean, how absolutely ridiculous it is to think that you can have the foresight to see an opportunity. You might get lucky. There's no doubt about that, but the odds are, right? And if we're going to be successful professional investors, we invest with the odds, and the odds are is that you're probably not picking that off. So, it's really interesting. I was with a high profile employee at a pretty big growth company, and he was talking about, well, I get these cool opportunities. I write $100,000 check here, $200,000 check there, and before you know it, he's got this small portfolio of stuff that really doesn't have the proper due diligence. Now, that's money that fortunately he could probably just walk away from, and it's going to be okay. But if you want to be a successful professional investor, it does go back to that structure and that plan. And that's something I talked to him about. Is that's great. Now you feel overwhelmed because you have all this stuff you don't know. But what would have been a heck of a lot more successful is if we would have sat down and gone through your priorities and said, hey, here's the money that you need to bulletproof your family for the next 50, 75, 100 years. Here's the part that we got to keep liquid for all of your important priorities. Okay, you want to go work on your multi-generational wealth, which is the specialty of working with a family office. Now here we go at the private side, and let's do this in a way that is the most successful. And I think everybody gets really excited about the private deals, but even in that example, it was just peeling back and going, well, we're talking again about the absolute weeds here. Let's go back to your overall structure, but then, like you said, Justin, from a public investment standpoint, right? We know active is worthless, but just really even looking and saying, okay, what is the most successful piece here? How do I stack up my odds? And then don't get all caught up in the emotions of reading tea leaves and this and that and trying to figure out like, oh, who's going to give me the advantage here when we know that the information is actually pretty efficient. So, how you go about this stuff is actually fairly simple when you break it down, right? It's diversification, it's global, it's being in the right investment vehicles.
Yeah, I mean, I think the thing to underscore here, the comment you made to underscores the how here is stacking the odds in your favor. And it is simple. I mean, and any good outcome should be a simple version of a very complex system. It's not to say investing isn't complex. Is it confusing? Are you inundated with noise? Are you inundated with these bright, shiny, carrots, if you will? Yeah, we all are. I mean, you want to, you want to go after this private investment that your buddy, has access to, whatever the case may be. There are so many examples of this on the private or the public market side. It's, hey, I want to find the next Tesla, but the odds of doing that are very, very, very low. Can you do that with a small portion of your portfolio? Yeah, by all means, right size those entertainment plays. But if you truly take a step back and think through what's important, what are your priorities, and then look at the data. I mean, it's incredible how much data we have in front of us nowadays, both on the public market and the private. It's way better on the public market side. We understand that marketplace a heck of a lot better than we do on the private side. But we do know that that the top tier on the private side outperforms over and over and over again. And if you don't have access there, it's just not worth it. I mean, don't even try, kind of to what Brandon was talking about earlier. On the public side, active doesn't really make sense. Going all passive generally doesn't make sense at all. It's a better outcome. It's a better way to go, but you can be smarter. You can implement through what are called factor-based investing lenses to be smarter than the index, be like the index, but be smarter than the index. And you're stacking the odds in your favor. If you think through your priorities, build your portfolio to support those, thoughtfully allocate to public markets, make sure you can get access to sound private market investments, whether that be in private equity, venture capital, real estate, debt, so on and so forth. Really ask that. I was listening to some venture capitalists talk last week too. He said one of the first questions he asks himself, and this, relatively successful, not a bulge bracket, Silicon Valley firm, but plenty of a great track record, plenty of a strong track record. He said, why am I seeing this deal? What value am I able to provide to this? And why am I actually getting an opportunity to take a swing at this? That's an incredibly important question to ask yourself. If you're just there to write a check, you should probably say no.
Yeah, I think it's fantastic. And I think a good summary of this whole conversation after listening to you talk about that is, do you want to be the house? Do you want to be the one dropping the ball in the roulette table? Or do you want to be the guy that's picking numbers, right?
Yeah.
Everybody hits the number once in a while. Everybody gets lucky but you would never, no rational human being is going to go into a casino and be like, oh, that guy's hit 36 three times. He's a genius. I should put all my money with him. No, we all know that the house is the way to go. Even when you get caught up in the excitement of hitting the number, if you pull yourself back out, it's no different in investing. You want to stack the odds in your favor. You might, if you guess, you might hit a stock, and that's what kind of fuels this whole thing, I think. But if you're one of these people listening to this, you have the wealth that we're talking about. You understand the value of a family office. It's getting out of this product driven sales culture and really putting together a sustainable plan for multi-generational wealth. Like, that's the point here, right? The point is to manage your money in a way, your wealth in a way, so that you can make impact far beyond your lifetime, hopefully for future generations, maybe in your family, maybe community, maybe the whole world, depending on your resources. But go find yourself a family office that is a good fit for you, because that's where you're going to find the advice to build a portfolio like we're talking about and truly invest like a pro. So we'll wrap up here, but head on over to awminsights.com. Sign up for our newsletter. We shoot out some good stuff there. I think would be really applicable to anybody looking for a family office. And then we also have a download there that's actually goes into the value of a family office. So we'd love to send you those resources. But until next time, own your wealth, make an impact, and always be a pro.